just move this way. Good morning, ladies and gentlemen, and I'd like to add my welcome as well for what is my first occasion at the summer school, a unique occasion. I've often found myself speaking on tricky subjects or in tricky spots. I can put hand on heart and say it's the first time I've addressed an audience where there's a uniformed guard at the back of the hall, and I don't know whether that's for you or for me. What I've put together is some thoughts, and that's why I've put a question mark. I don't think there's a prescription at the moment or a set of tablets that we can set out and say this is the way forward. And for that reason, I've put a question mark. It's not a fixed agenda, as it were. The areas that I propose to cover is the public finance constraint, which there has been a lot of talk about, the deteriorating competitiveness position, the matter of achieving fiscal balance, public sector reform. I think that's one that's going to come back on the agenda in a very serious way, simply because I don't think it will be possible to achieve a durable fiscal position without fundamental public sector reform. It's a topic that keeps coming up every so often, and everybody bows towards it, and nobody does anything about it. We'll say a bit about that. Reversing competitiveness losses, where some things might be done about that, and talk a little bit about some sector development initiatives which are in train. And what I'm talking about here is the initiative of the smart economy, which gives you some reason, I think, for hope. It probably, in my view, hasn't got the kind of headlines it deserves, and I'll say a bit about that. And finish with some concluding thoughts that might provoke discussion and stimulating some questions. So starting with the question of the public finance balance, I mean, this chart basically shows the line is GDP growth, and the red bars are basically what we call the public finance deficit or surplus. And above the line is a surplus, and below the line is a deficit. What's notable about this chart, and you'll see it as I go through the charts, is that the public finance balance followed very closely economic growth. Now, there's nothing unusual about that. What is slightly different in Ireland's case from other countries that I'll show you in a moment is how closely related the public finances are to growth. And the reason for this is because Ireland's tax base is very much transactions oriented. And when growth is high, tax revenues are very buoyant and the public sector goes into surplus. And conversely, when growth falls, the opposite happens. But the degree to which that occurs is a bit different in Ireland, and commentators have attributed that to the narrowness of the tax base, the fact that a lot of taxes are transactions oriented and not based on capital values. Now, as all of you know, the Commission for Taxation report will come soon, and I think it will probably provide an agenda of reform around that aspect. And the other point that's important is growth itself. And there are two critical aspects to that. Ireland is the blue line. And these comparative charts are showing Ireland in blue, the UK in green, Germany in yellow, and the euro area as a whole. And you can see that for most of the decade up to 2007, Ireland's growth rate was substantially above all of those other countries. And by substantially, you can see in the early parts of the decade, by more than twice as much as the euro area, in fact by more than twice as much as any of those countries. And it was great, and we were all enjoying it. But there's a subtlety in here. Not only was the growth rate a great deal higher than those other countries, but from the early 2000s, in fact from 2002, 2003, there was a very significant change going on with the composition of growth. So if you take the 5-year period, 1998 to 2003, something like 27% of the cumulative growth that occurred came from net exports. In the next 5-year period, or the most recent 5-year period, that contribution halved to 12 or 13%. So what was happening was domestic demand was gathering pace, and growth became more and more reliant on domestic demand and less on net exports. And that domestic demand was driven by households, companies, government spending, and critically borrowing more and more. And household debt rose way above per capita what was happening in other countries. And if you ask me personally what went wrong, that's what went wrong. Growth continued, but the basic character of that growth changed in a way that is fundamentally unsustainable. Growth wasn't based on competitive production of goods and services and selling them on international markets. It was based on leveraging more debt out of inflated asset prices, notably property prices, and driven by domestic demand. And with that, of course, as I showed you in the previous chart, the public finances appeared very, very strong. Surpluses. Unlike the other countries of Europe, the ones that I'm comparing with, that's Ireland in the sort of pink colour, the UK in green, Germany in red, Euro area in blue. And as you can see, for most of this period, we were bombing along with a surplus. Those countries were recording deficits of, between 2 and 4% of GDP, while we were recording surpluses of that amount. So, this was the so-called miracle. And in the early part of that period, it was a miracle in the sense that the growth was coming from external demand, exports driving growth forward. And in the latter period, it wasn't. But we were deluded until it all collapsed from 2007. And remember this figure for the deficit in 2008, showing Ireland with having swung from a surplus to a deficit of close to 8% in 2008, and probably looking at 12 or 13% this year. And as a result of that, Ireland again in the pink, you can see that the debt, the overall level of debt, having fallen compared with those other countries up to about 2005, 2006, has begun to rise again and will rise further in 2009. Add to that the requirement to guarantee deposits from September of 2008, adding a further contingent liability to the public finances, and the consequences of resolving banks' balance sheet problems, which will add further to the national debt. You can see how a crisis has accelerated and why the national debt and the deficit has gone from a very comfortable position relative to other countries to a very poor comparison. Now, what do we have to do about the public finances? There's nothing new in what I'm saying today. There's nothing I'm saying in this talk that hasn't been said by other people at different times. What I hope I might achieve is to put it together, and we'll see that when I come to the conclusions. The first thing, a credible target. confidence, both within the country and outside it, is so poor that I think a key factor for any government dealing with any problem is that if you say it, you better do it, and you better mean it, and you better deliver on it, because every time you miss a target, I think it's a further ratcheting down in confidence that can't be afforded. The right kind of target for the fiscal balance is what's called the structural deficit. And to be fair, government used that concept in its... and what a structural deficit is, it's that bit of the public imbalance, public finance imbalance, that won't go away with a resumption of growth. Now, there's a bit of a snag with this. The ESRI came out with an estimate of what that structural deficit was. They said 6 to 8% of GNP. The IMF came along more recently and they said, no. According to our calculation, and this is a bit like, doctors differ and patients dying, and they came along and said, look, in 2007, when you were in balance, really the structural deficit was 8%. In other words, that it was all a result of the growth, excess growth that wasn't going to be sustained, and that since then the structural deficit has grown to 10 or 11%. Now, if the structural deficit is at 10 or 11%, we ain't seen nothing yet. That's one point. And I think work needs to be done by professional economists, and a robust consensus needs to come about that would provide guidance to government and their advisors on what kind. I mean, removing 6 to 8% of a deficit against a global economy that's weak is a formidable task, and when you've lost competitiveness. And that brings me to the second point, the realistic time frame. You're caught between a rock and a hard place. Adjustment over too protracted a period is going to leave that level of confidence within the economy low, dulled, and so there's a tendency, well, look, do it quick and get it over with. But there's a balance. You can't remove that kind or achieve that kind of adjustment in so short a period without doing extraordinary damage to the economy and its society. So it's certainly a multi-annual process. Is it 3 years? Is it 5 years? Maybe it's 4 years. But it's 4 years of hard graft. Finally, there's the question of the balance between revenue and expenditure adjustment, sort of an ongoing debate. I think this little table is an interesting one. It's showing Ireland and the euro area and 2000 and 2008. And the key things, I think, to look at here is if you take the top line, total revenue, Ireland's total revenue fell from 36% of GDP to 34%, call it, of GDP. Europe, the euro area, a bit less. But look at the expenditure line. Total expenditure in Ireland as a percent of GDP rose almost 10 percentage points. So it was a great holiday. Revenue fell and expenditure rose. Now, if you look at the rest of the euro area, what was happening? Revenue fell a bit, 1.5% of GDP, and expenditure remained constant. And that's it. That is the Irish public finance problem. And that is, and I put the emphasis, that's the Irish problem. Everybody has a public finance problem, but that's why the Irish one is different. Now, if you look at where the growth in expenditure came, well, compensation of employees, that would be numbers and pay rates, up from 8% to 10.25%, in line with the euro area, and social benefits up from 9% to 13.5%. Now, There's a very substantial point contained within this table, which is taxes in Ireland relative to the EU. Taxes, not total revenue, taxes, the difference being social welfare contributions. Taxes in Ireland are a little over 2% of GDP lower than the euro area, down 2.5. They were in line in 2000. The big difference is the social welfare system in Ireland compared with the euro area as a whole. You can see that in the social contributions. Ireland's social contributions they're low. This isn't new. Everybody has known this. But I think we may have entered the delusion in Ireland of believing that we could have European social benefits and Anglo-American social contribution levels. That's part of the problem that we have. I think it's far too big an agenda for Ireland to say, well, look, we need to move to a European social welfare structure. And the fundamental difference of which is that it's the pensions provisions which are provided for on a voluntary private basis in Ireland as it is in the sort of Anglo-American model, compared with state provision of and the other social benefits that are there. So that's something. If you want to have the social benefits of Europe, you're going to have to face the social contributions that they have as well, and we're a mile away from that. And if you don't, you can't deliver the benefits. And to have tried is part of the problem. We can come back to that in the conclusions. Delivering public sector reform, as I said, it's been talked about, and everybody says, sure, it would be a great thing to do. We should definitely reform it. And, the headings under which, National Competitiveness Council, I see Don Thornhill here, and, I filched what I have to say from your report, Don. A move to an integrated and coherent system. It has all been said. New governance structures. Look at the regulators. Are the regulators regulating in the interest of what they were there, or have they become captured? Has there been a proliferation of them? The question of integration and coherence. The issue is, I think, with here is whether or not you have the management experience in traditional public administration to undertake the kind of adjustment that's implied by that previous chart, which is consistent with Colin McCarthy's menu. People say, is it an a la carte menu? Is it a fixed menu? I'd add my own words, it better be an early bird menu. And I think the question becomes, and it's what I return to in the conclusions, the question becomes, how do you deliver the reduction in the inputs without reducing the outputs? How do you get productivity and change in the delivery of public services? And if you don't get that, then the initiative will fall flat on its face. People will reject it. Now, let's park that and turn to the question of competitiveness. In the IMF report, when you read the IMF report, they talk about Ireland's share of exports in UK and Euro area imports declining. They talk about price levels in Ireland reaching the highest, becoming the highest in Europe, deterioration in unit labour costs. If you have a cup of coffee in Paris, you're probably saying, Jesus, it is expensive at home, or a glass of wine on the Côte d'Azur compared with one in Ireland. The evidence is there. This, just for summary, this is called a harmonised competitiveness indicators. It takes a whole bunch of indicators. It's done by the central bank, not by me. And it compares those indicators in Ireland compared with the countries we trade with. And they do it in real and nominal terms. And this chart starts in 1998. As you see, it improved when it goes down, that's an improvement in competitiveness. But from 2002, it deteriorated and has continued to deteriorate. And today, compared with 2002, what this indicator says is that we are off mark by about a quarter, about 25%. And that brings you to the nub of the problem. Go back to the chart I spoke about, the growth rate and that public finance deficit. If you're going to remove, be it through expenditure or through additional revenue, 2% or more of GDP per annum, sustained over 3 or 4 years, to achieve that ex post is going to require greater reductions ex ante, unless you can engender some growth when the green shoots that are being spoken about internationally currently develop. It's probably a bit of a lost cause. So competitiveness and adjustment of the public finances have to go hand in hand. I think it's insufficient to talk about adjusting the public finances unless there is an initiative to improve competitiveness, particularly when it's not a marginal improvement. I mean, a quarter is a lot of competitiveness loss. It was masked by what I was talking about, that sustaining of growth through domestic demand and building up public expenditure on the back of a revenue base that was basically built on sand. Well, what can you do? You can't sort of move competitiveness 1% a year, or we'll be here forever. So you do need, quite a dramatic initiative. And if you look at where policy can actually do things, these are the headings under, and again, they are headings that have been identified: National Competitiveness Council, others as well, the Competition Authority most recently, when it came to look. These are the things, these are the costs that are within government control and that are part of the reason why competitiveness has gone off track. So I think they're a very significant initiative of bringing those costs back into line is a necessity if we're going to achieve that public finance adjustment. Now, the sector development initiatives, the smart economy, and I think I put this onto the chart because, and it's worth, the Ireland of the future will be a smart, high-value, export-led, leading research-intensive multinational, thousands of innovators. At least it's a vision. Some people might scoff and say, how are we going to get there? But it is the right vision, and it's a vision that has been at least articulated, and there has been an innovation task force put in place. There has been an objective of establishing the country as an international innovation hub. And unless there is some initiative like that, which is put into which there are serious resources to implement that on the ground and achieve a resumption and bring about a competitiveness gain, then that adjustment of the public finances will elude us long into the future. So that gives me a great deal of hope. What worries me a little bit is that it hasn't grabbed the attention of the crowd. The attention of the crowd is still focused on we have to reduce expenditure, raise taxes, there's no hope, unemployment is rising. But I think there is this, and it is very important. It's been spoken about later in the conference, which I think is very, very fortuitous and prescient of the organisers. So what's my conclusion? Well, it's an optimistic one. The pieces of the jigsaw are actually there. They're not mine. Other people have put them there. Fix broken banks, achieve a sustainable position in the public finances, reverse competitive losses, and have a clear vision about the kind of economy needed to foster future growth and employment. And those pieces are on the table. The what needs to be done, I believe, is there. I would argue about details. What's the structural deficit? Or is it bigger or smaller than 6%? They're details. The big questions are there. What's not there is the how to do it. How to achieve those changes. And I think part of the problem, and this is a thought, is that we've measured economic success by spending, not only in government but also in the household sector. The whole last 10 years was about domestic spending. A lot of it was very conspicuous spending, and the government itself wanted to spend. They wanted to spend for right reasons, improve social benefits, give people extra, but spend, rather than create, bring change, and move that to the forefront. And I think that needs to be done somehow. It's not an economist's job. It is a governmental, thank God, it is a governmental society thing. How do you bring about the public sector reform that I spoke about? It's about creativity and change. So is competitiveness. So is innovation. To the point that that I would say that a culture that measures success by an ability to create and manage change is needed to piece together the jigsaw I've described. Thank you for your attention.